Hello everybody. What if I told you that a smaller budget could actually mean a more powerful company? For years, the biggest bear case against NIO has been its massive, seemingly uncontrolled spending, especially on research and development. Critics claim they were burning through cash with no path to profitability. But a major shift just happened at China Automotive Chongqing Forum that completely changes the narrative for the NIO stock, and the numbers are finally proving it. New Associate VP of Brand and Communication Ma Lin just revealed that even though their quarterly R&D spending is lower than it used to be, their actual R&D efficiency is far higher. In fact, it is now exceeding the total value produced by the massive multi-billion dollar investment of their past. So the big question here is that how they are pulling this off. It all comes down to a massive structural pivot, designing their own silicon. Look at the chip sector. Previously, NIO was spending a staggering 300 million every year just to procure Orin X intelligent driving chip from Nvidia. But by shifting their own proprietary in-house smart driving chip, the Senzi processor, they are completely breaking that reliance. Founder William Lee previously noted that replacing four NVIDIA chips with their own Sensi silicon slashes component cost by roughly 10,000 yuan per vehicle. This is an enormous margin booster as production scales. Even better for the long-term thesis. This chip isn't just restricted to the luxury NIO brand anymore. Management confirmed they have officially begun deploying the Sensi chip into the mass market Onvo brand this year. On the top of that, they started licensing this semiconductor technology to external customers, turning a massive historical cost center into a brand new commercial revenue stream. This isn't just executive optimism. We are seeing this physical discipline show up directly in the hard financial data. For the first quarter of 2026, NIO's R&D expenses dropped to 1.85 billion yuan. That is a massive 40.7% decline year over year, their lowest quarterly R&D spending in at least 3 years. Full year spending shows the same trend, dropping from over 13 billion yuan in 2024 down to 10.6 billion yuan in 2025. The company has completely reinvented how it operates through what they call the Cell Business Unit or CBU mechanism. It is an all-employee operational discipline where NIO is broken down into independent units. Each unit has strict return on investment target, fixed budgets, and absolute accountability. Engineers are literally logging their hours because personnel is the biggest driver of R&D costs. William Lee has made it clear internally, no project moves forward without a clear financial justification. They are adopting the hyper-lean operational mindset of global giants like Toyota and Hyundai. And the financial turnaround from this discipline is already hitting the bottom line. NIO just reported a vehicle margin of 18.8% for the first quarter of 2026. That is their fourth consecutive quarter of margin expansion. Even more impressive, they achieved a positive non-GAAP operating profit of 66.8 million yuan, while their net losses narrowed down to just 332.1 million yuan from a massive 6.75 billion yuan a year ago. They are sitting on a very comfortable cash cushion of 48.2 billion yuan. Management is keeping a tight grip on the wheel, guiding for quarterly R&D to stay capped between 2 and 2.5 billion yuan for the rest of the 2026, while targeting full year non-GAAP operating profitability. What makes this financial turnaround so incredibly bullish for the stock is that it is happening right as NIO enters its most aggressive production delivery cycle in the history. They aren't shrinking their business, they are scaling it more efficiently. Deliveries for the flagship ES9 executive SUV began in late May and are already on track to top 10,000 units in their very first full month. The mass market Onvo L80 SUV launched in mid-May, and the compact Firefly is showing immense strength. In total, NIO delivered over 83,000 vehicles in the first quarter alone, a massive 98.3% increase year over year. And looking ahead to second quarter, they are guiding for up to 115,000 deliveries, representing a 59.6% jump. The bear case is officially evaporating. NIO has successfully transitioned from a speculative high burn startup into a mature, disciplined, and highly efficient EV powerhouse. They are delivering double the vehicles with a fraction of the R&D cost, proving that their ecosystem is structurally built to win. With margin expanding, sub-brand scaling, and full-year profitability finally within the reach, the risk-to-reward ratio for new stock has arguably never looked this attractive for long-term new investors. So prepare now. With that said, thank you so much for being here. See you in the next one.